Welcome to the course of Company Valuation. Company Valuation is an elective course that is going to build on two core courses, Financial Accounting and Corporate Finance. The link between Company Valuation and Financial Accounting is going to be very direct. We are going to use essentially the entire accounting infrastructure to develop our valuation models. What is going to be the difference between Financial Accounting and Company Valuation? In Financial Accounting, we have learned how to understand and interpret financial accounting numbers that are published by companies every quarter. In Company Valuation, we are going to use that knowledge to analyze how well the company did in the past, to make a forecast about how well it's going to do in the future, and based on that understanding, to estimate how much it is worth for investors. When it comes to corporate finance, we will need the concept of the cost of capital and the discounting tools in order to be able to convert the future expected cash flows to the present value. So you can say that company valuation is essentially a process of putting a price tag on a company or its part. And that happens quite frequently in the business life. Company valuation will be useful for a fundamental investor who is analyzing the company, trying to estimate its intrinsic value, then trade on it and earn profit on the subsequent correction of the mispricing. However, company valuation will also be useful to a manager who plans to issue the company's equity in the public market for the first time. In other words, to make an initial public offering, IPO. Furthermore, valuation will be important for an investment banker who is preparing the company for a merger or an acquisition. And finally, valuation may also be useful for a public representative or a governmental minister who is preparing a company to be privatized. So as you can see, the scope of use of valuation is very broad, and therefore I hope you will find the course beneficial and useful for your career. We live in somewhat unusual times, and therefore teaching this year will also be different. In particular, we will work together while being at different locations. That will certainly constitute a challenge, and you can trust me that is no less for me than it is for you. However, you may know that in Chinese they have the same word for crisis and for opportunity. And I hope that this challenge will also constitute new opportunities to find interesting, effective ways of how to organize our online teaching. I have prepared a number of innovations to the course that will allow us to interact even outside of the virtual classroom that we will use for the lectures. The video that you are currently watching is one of those innovations. Before every lecture, I will record a YouTube video that is going to introduce the topic and that is going to ask you several questions to think about. In addition, I will send you a link to a Google form where you will answer these questions before you come to the classroom. This will make you start thinking about the topic and considering some important aspects that these can actually have. How are we going to use your answers? First of all, I'm going to use them in the class. I will show you what most people thought was the right answer, and we are going to discuss whether it indeed is or not the right answer. In addition to that, I will see how you think about these topics, and I will try to adapt my lecture to your answers to address some of the points that you raise in your verbal answers to my Google form. And finally, to boost your motivation, it will also be a part of your grade. What I'm going to do is that I'm going to decrease the importance of the final exam, and instead I'm going to give you some points for the answers that you provide to me every week. Now, I do acknowledge that learning online will be new experience for most of you, and indeed it will be new experience for me too. However, I do hope that we are going to enjoy it. We have started online teaching this spring in Prague, and when we made a survey at the end of the term, it turned out that most of the students were very happy with the service we provided. And in fact, some of them told us that they even prefer the online teaching to the in-classroom teaching. So I do hope that we are going to interact equally effectively, and I'm looking forward to meeting you in our virtual classroom. Let us start by exploring the menu of valuation approaches that we can choose from. Imagine you build a house, an office building in the city center, and you want to sell it to customers who will use it as their headquarters. What possible ways do you have to estimate how much you should sell it for? Well, of course, the easiest way would be to do something like this and use your intuition to guess the price. Now, psychology teaches us that intuition is a very useful cognitive tool. It's a shortcut to many decisions, but psychology also teaches us that intuition can very often be very deceptive and lead to incorrect decisions. So let us say that you want something better than that. You want to have a more rigorous approach. My question for you is, what are the rigorous quantitative approaches a firm can use to value an office building? You will see that essentially there are three main approaches. That is to say, three sources of data based on which you can perform your computation. At this stage, I do not want you to discuss the details of the various valuation models, but instead, I want you to discuss their philosophy and the sources of data, sources of inputs that they actually use. The previous question addressed a very generic valuation setting when I have asked you to consider approaches that would be suitable for valuing a house. Nevertheless, for the most part, in this course, we will discuss how to value companies. And when it comes to valuing companies, not all three approaches are equal. Some of them are more, and some of them are less suitable for valuing firms. And that brings me to my second question. In my second question, I want you to discuss which of the three approaches are more or less suitable for valuing firms. I suggest you start with discussing the advantages and disadvantages the three approaches have. And from that, you can draw some conclusions as to their relative suitability in the setting for valuing companies. Ultimately, I would argue that there is one approach that is very useful and one approach that is not useful at all. And then there is a third approach that can be useful depending on some conditions. So let us see if you reach a similar conclusion or if you will differ, and we will have a good reason to have a nice discussion at our first lecture. The origin of the word valuation comes from the word value, and therefore it is reasonable to expect that the two will be very closely interrelated. Let me propose that companies will be valued based on how much value they will create for the investors. Now, if that is true, it is going to be quite essential for company valuation to measure or estimate how much value the company will create in the future. And this brings me to my third question for you today. The third question is, when do companies create value? Imagine this is an annual general meeting. You are shareholders in a company and you have elected me your manager. Now, I'm reporting the results of the company of the past year. What kind of results will be good enough to make you happy? That is to say, when will you consider that I have done my job well and I have created some value for you? Now, I am purposefully rather vague as to the definition of the word value. I want to have a conceptual discussion that discusses the intuition about value creation. However, you will see that the concepts that we are going to ultimately use in the valuation models will be very closely related to this broad concept of value created. To give you a hint as to how to answer this question, remember that accounting will be a very useful point of departure for much of the valuation exercise. But here, accounting will be the beginning, but not the end. And the reason for that is that investors make their investments with some kind of expectations, some kind of predictions. And these will be closely related to value creation. So in other words, when determining whether companies created value, you will be comparing two numbers or two concepts. One of them will be based on accounting numbers, and the other one will not. Try to figure out what these two concepts are.